Alright, good morning then folks, as we head into European trade on Tuesday the 26th of September. We'll have a look across the headlines, we'll jump across to some charts now in a minute. We'll have a look at the movement on a morning pretty lacking so many high impact economic data overnight and obviously into today as well. Monday, Tuesday, pretty slow days on the calendar, which means markets have moved in line with how they have been moving over the last number of weeks. You can see yields march higher, which is no surprise. Stocks sag amid Fed angst, and again, expectations for the Fed to either hike interest rates again, or if they do, or if they don't, at least to continue on with interest rates at this level for longer than markets had anticipated, and that is positive for yields, which in turn is positive for the US dollar, negative for stocks, and that is what we are seeing take hold again. We saw a little bit of a bounce back in stocks yesterday, sold back into overnight, and they continue lower as we head towards 8 a.m. this morning, and that is really the story of markets. We were looking at it last week on these videos, again pointing, just staying with your trends, hoping that these trends continue, as there wasn't really anything in the way bar any surprises in order to go and change that after the central bank's decisions last week, especially on the Fed plus the Bank of England kind of going different ways at the moment. Fed potentially going to hike interest rates again, Bank of England looking at stopping, looking like they're going to stop, should I say. The ECB the week before looking like they're going to stop. The S&B expected to hike interest rates but didn't. The Bank of England expected to hike interest rates but they didn't. So markets, certainly those three central banks, seemingly predicting that they are finished. They kind of did allude to being finished once you had their statements out with their interest rate decisions. A couple of them, as I said, not hiking when markets had anticipated. You then come to the Bank of Japan, who still interest rates at negative levels, still employing yield curve control, QE, all that sort of jazz that we've spoke about a lot on these videos. And again, the US is slightly in a little bit of a different place. Economic data in the US continues to be positive. Europe, the Eurozone and the UK not so similar. Again, interest rates stopping in those countries, potentially going higher again and staying higher for longer in the US is a recipe for US dollars higher, certainly against euro, sterling, Japanese yen and the Swiss franc, and that is what we are seeing. The Aussie and the Kiwi have held up pretty well. Australia dollars, New Zealand dollars resilient as US yields surge, which is interesting. If you do get a turnaround, stocks do start to push higher. You get a bit of and yields push lower, and you get a bit of risk on trading. I think your Aussie and your Kiwi are the ones to play. Then you're going selling. If you're going buying dollars, I wouldn't buy them against the Aussie and the Kiwi. But if you go and sell dollars on a bit of a pullback on the dollar, Aussie and the Kiwi seem the ones to play. Dollar CAD holding up, or the Canadian dollar holding up relatively well as well. I come across to the grid, you can see that just relayed in markets. You can see US equity futures, European equity futures, Asia Pacific equity futures, all lower across the board. No matter where you look, their 1 week percentage change is just red across the board. So we'll see a red across indices again this morning. Commodities lower across the board, as you can see. Bonds lower across the board, so bonds continue to be sold while yields continue to push higher. That lends some support to the US dollar. Translate that across the FX a little bit mixed, a little bit all over the place, apart from your Australian dollar, which is lower across the board. But even then, I say lower across the board, it's pretty flat against the majority of other currencies. So not too much going on in FX land as of yet. Obviously, we're half an hour away from European Open. Obviously, it doesn't affect the currencies the same way. European trading session yet to kick in full swing, but stock indexes lower across the board, yields higher, dollar higher is what we have been seeing over the last number of weeks. You come across to the calendar, Monday's economic data, not a great deal. Tuesday's economic data, not a great deal. As we come a little bit later on to the week, we do have some durable goods orders the US tomorrow, some consumer confidence figures tomorrow, but then into Thursday and Friday we do have some economic data to work with, where we'll get to German inflation, US GDP, and then US inflation, core PCE on Friday, and then Eurozone inflation on Friday. But we'll break that down when we get to it a little bit later on in the week. But as of now, Monday and Tuesday, not a great deal of economic data to go off. Therefore, moves from last week then continue, and you can see the sterling continues its trend lower, dollar Swiss continues its trend lower, dollar Swiss continues its trend higher, Swiss franc continues its trend lower, dollar yen continues its trend higher, euro dollar, it's a bit of a flag on the euro dollar, isn't it? I mean, do you want to go and sell it again? I don't think it seems like too bad of an idea. Bit of a flag, pennant, whatever way you want to try and spin it. Does look like a bit of a continuation pattern for another move lower. Dollar yen, though, I think is a tricky one to continue to chase at these levels. We are now approaching that 150 level where the central bank have looked at intervening a couple of times. It has reached that in the past year or 18 months. So if it gets up to 150, certainly becomes a tricky buy up there. 151.944 was the exact level where they intervened last year. You can see them step in up here in October of last year. So I'll certainly be keeping that level on my radar, 151.944. If we do reach up there, I'd imagine, even if we don't get some intervention, you'd imagine there will be at least some chatter of some information. If we at least some chatter of some intervention. If we do get up there, I'm gonna get back to current price. It's taking me a while, but we can see it here, up above 149, broken above 149. I mean, in this sort of in the last half an hour or so. Do you want to keep chasing it higher here? I mean, you'd still rather buy it than sell it. Obviously, there's no indication that this turns around just yet. It's just in an uptrend, trending higher, making fresh higher highs. It's not a situation where you want to jump in and sell this just yet. Do want to see a little bit of confirmation, some sort of reversal pattern or an aggressive move lower. Well, if that does happen, you should be in for a decent bit of a move lower. I think back towards 145 would make sense on this, but not just yet. Do need to give that a bit more time, to play out. Certainly is not a trade for today. If you're taking a trade for today, you'd rather be long, but personally, I'd rather be long dollars and something slightly different, even though that probably should continue higher in the near term. Stocks, as I said, rallied yesterday. US session yesterday had a bit of a pop higher. Rallies just sold back into S&P, the Dow Jones, the Nasdaq and the Russell. Haven't broken through lows nor fresh lows this week. I mean, did slightly yesterday, to be fair. But do we get back down towards these lows, back down to 4,300 on the S&P and then continue lower? Obviously, it remains to be seen. But stocks continue to be put under pressure as we head towards European trade today. Some aggressive downside on European stocks at the open yesterday. DAX, the Euro stocks and the FTSE all pretty aggressively lower on the open, or just after the open in yesterday's trading session. So stocks under pressure across the board, US dollar higher than this. We've had a kind of 11 percentage point move on the 10-year yield, so a massive move yesterday in US bonds. The 2-year not following. Certainly has not managed to establish the same levels of upside, albeit a small bit of upside. It's gone from what open yesterday, 511 up to 515, so 4 percentage points, but massive move on the 10-year yield yesterday. That's likely to continue to put stocks under pressure and be positive for the dollar. Gold is another thing that does not like. Yields pushing higher. Gold has broken through these lows, making an attempt and making fresh lows, and the fact that those lows have now been taken out, you would probably look for these lows back here at 1900 or 1903 to be tested at some point. Right, ongoing US dollar strength, yields continue to push higher, continues to be a negative for the price of gold. Onto oil. Strong dollar is not a positive thing for the price of oil. The more the dollar pushes higher, seemingly, I was just reading an article on Bloomsbury suggesting that oil's rally towards 100 has been halted off the back of a strong dollar, which has outweighed tight supply. Obviously, you've got a massive move off the back of tight supply. Bit of a reversal wouldn't be completely unsurprising. You do have this bit of a level down here, kind of 89. Maybe I prefer drawing a kind of a bit of a zone that you've had a dip into or a tap into. You know, if you can break through that. I'm struggling to make highs back here, and here, making lower highs now down to it. You'd expect this probably to fall, a bit more of a pullback. I do still think long term buying it is probably the way to go, but it looks like it wants to head lower. Do you reject off this support level down here at the round number of 89, in and around here as well? Keep an eye on oil at this level. Does it break lower, continue its pullback? Does it reject here dips get bought. Really, it's at a bit of a junction point where the markets, or the charts should I say, need to be looked at for some guidance going forward. But dollar continues to trend higher, stocks continue to trend lower, US yields higher aggressively over the course of today. No high-end back data to change that over the course of today. So you'd have to imagine that continues as we head into European trade for the day.